Who wouldn't be happy with a gain of almost 10% in under 2 months? The answer is Asian investors. Emerging markets worldwide are enjoying their best start to the year relative to developed markets in 5 years. But analysts report investors based in the region are resolutely focused on what might go wrong. Call it the battle between Trump-related fear and corporate fundamentals. This year, the MSCI Emerging Markets Index has gained 9%, its developed world equivalent 5%. Last week, EM funds attracted their biggest inflows in 6 months. Yet analysts touring Asia report a series of yes but discussions, sort of dwelling on the dollar's persistent strength and the risk that President Trump will impose punitive trade tariffs. With that in mind, it seems most likely that the gains to date have been driven by inflows from elsewhere. Investors who have benefited from the strong rally in the US, for example, they've made enough now that they can afford to think about taking a little bit more risk. So far this year in the EM world, riskier cyclical stocks have outperformed, including energy, miners, technology, and even unloved financials. Perhaps investor caution is down to having missed the move. Analysis by Citigroup shows EM funds are most heavily vested not in cyclicals but defensives, and they were the must-have stocks of last year. For investors who can bear a glass-half-full perspective, Asia hope lies in falling levels of overinvestment and a newfound emphasis on cash flow. Companies will cut capital spending by more than 10% in Malaysia, India, Indonesia and China in the next 2 years, according to forecasts at Bank of America Merrill Lynch. Their analysts expect free cash flow in the region to double as a result. In a region where companies are typically managed for sales growth, not the bottom line, improvement in cash flow would really represent a long-term shift worth watching. So long as investors can bear to live with their Trump fears, that is.